We've had 4, 5, 6 wonderful years. Your wonderful research says not so much it's over, but it's unlikely to continue. Is it a single-digit world that gets us to Dow 20,000?
I think that that's exactly right. So had we been discussing this same topic 3 or 4 years ago when we first published this work, the Dow was at around 12,000, and it was controversial whether or not we could even envisage Dow 20,000 within the foreseeable future. And our view was it's very likely to happen well within the decade. Now, at this point, I don't think that's the question. To me, the question in the next few years is not do we hit Dow 20,000, it's how many times do we trade through it.
Exactly, exactly. And here's a beautiful chart which shows what we did at Dow 10,000 as well, where we bumped along. And what this comes down to on a physics basis is inertial force. That comes from earnings. That comes from cash flow. Are you just assuming that inertial force goes away or drifts away as we move ever higher?
Well, I think what happened over the last few years is actually that cash flows rebounded very strongly from the low in 2008. And for the first 3 years of the recovery, it was actually the strong earnings that were driving the market up, because PEs were, if you remember, declining during that time. People were so skeptical about stocks. In the last 2.5 years, PEs have gone from very low to slightly above historic norms. So going forward, it's going to have to be earnings that take us the next step of the way. And we think that that's going to be a slower process, as you suggest. So returns will be much more modest. I think high single digits is a good guess. Probably 6 to 7% is our forecast. And there's going to be a lot more volatility. And that's not a bold forecast, because, in fact, volatility for the last few years has been unusually low. And that's a lot because of central bank action, especially the Fed, essentially suppressing risk with their quantitative easing programs. Now that they're stepping back, we're going to see volatility return to normal, which is a lot higher than most people are used to.
One of the things we've been seeing out west is that companies are waiting much later to go public. All the growth is happening in the early stages of investment before they actually hit the open markets. Is that period when there was amazing growth of new companies on a publicly traded market, is that over?
I don't think it's over. I think what you're describing is definitely happening in certain areas like tech and pharma. And it's happening because the money is there.
Yeah.
There are huge pools of money that are eager to invest in privates and do so on terms that we think are, in many cases, very generous. So why wouldn't you do that? That's not a forever thing.
The backstory to your fan distribution, Vonnie, and Vonnie, this goes into what you and I have talked about before. We're up to our eyeballs in money. Whether it's private equity or bonds or whatever, we're up to here with cash.
The question is, what growth would we need to see to bring us to Dow 20,000?
Well, I think that what's likely to happen over the next few years is that you're going to see growth be very moderate but continued in the United States, probably something like 2.5% GDP growth on average. Plus you add a little bit of inflation and you add some dividend yield, you get yourself to a total return on stocks of about, call it 6.5 to 7%. And that's not an extreme forecast. It's also not the only thing that we can envisage. And in fact, when we do planning for our clients, we're much more worried about the downside cases, because we think an investment plan is only as good as it is in bad markets.
A CEO is not going to accept single-digit growth. He's going to have a pressure from his board to do better. There are going to be companies that are going to be high single-digit, double-digit. How do you select those? How do you find those, particularly on this day where we see this tumult at Twitter?
And actually, we think that one of the big stories in the next 5 years is going to be a major shift from the last few, which is going back to where all you had to do is predict that the Dow was or the S&P were going to be up robustly. You could be just in an index fund and do great. And in fact, more and more people have been going that way. I think in the next 5 years, we're going to see active managers who have real conviction and are picking winners versus losers add a huge amount of value, because the indices are not going to be skyrocketing anymore, and distinguishing which are, in fact, the right companies is going to matter.
Vonnie had the right question about growth. I just want to follow up on that. Does Bernstein have a call on what long-term economic growth will look like in the U.S. 10 years out?
Yeah. So we think that there are lots of possible scenarios, and we want to make sure that our plans work even if things that are bad that we don't expect are likely happen. But we think the most likely scenario is that we'll see growth of about 2.5%. And here's the reason why. Population growth in the U.S. is actually pretty good, almost 1%. And that provides some inertia, some tailwind for us, which most other countries now do not have. On top of that, we think productivity is likely to continue to grow as well. This is a big debate, including internally. But our best guess is you're going to see productivity growth of somewhere around 2%.
That's a big call. That's interesting.